Let's talk macroeconomic trends. Now joining us now, Peter Kraus, Chairman and CEO of Aperture Investors. I guess this year you're fundamentally feeling okay about the markets, which is different than probably at the beginning of last year.
Yeah, I was. I think we changed our view. I changed my view. I think the economy weathered significant increases in interest rates. Jobs, kept on getting printed. We continue to have growth both in corporate earnings and in individual compensation, and people kept on spending. And, one of the things that I think I missed a bit is the level of interest rates on mortgages in the economy. I think 62% of homeowners have mortgage rates that are somewhere in the 3.4% fixed for 30 years. So you think about that. That leaves you with a very interesting transmission mechanism, or lack thereof, for the Fed. If you're increasing interest rates, when mortgages had variable rates, rates went up immediately. Now rates are fixed, and they're fixed at a very low level. So consumers actually have more discretionary income, and they're working, and they have jobs, and, things are actually pretty reasonable. Yes, inflation went up very quickly and caused a big change between their discretionary income and the cost of things, so they don't feel as good. But look, that also creates increases in labor rates, and that's why the Fed is having a harder time bringing rates down, because wages are not coming down. And they're unlikely to come down until there's a recession, and I don't see a recession in the next, 12 months.
So it's going to be a longer process for the Fed to get back to 2%.
Yeah.
But not, I think, implicit in some of the stuff I'm reading in your comments is that having normalized interest rates isn't necessarily a bad thing.
No, that's the whole point. I mean, we lived for many, many years with a 5 to 6% 10-year, and, the stock market went up 10% a year. And there's nothing wrong with that.
And it's nice when you can, when money costs something, and then you set prices and know what things are worth, instead of this weird.
We haven't had a particularly rational capital allocation process for probably 10 years. I mean, after the global financial crisis, the Fed and the central banks around the world really drove liquidity to unusually high levels, interest rates very low, and they did that to actually forestall a depression. And we could have had one, and we didn't. But the result of that was significantly different capital allocation than what we would normally have. And now we're trying to get back to a rational capital allocation. There are going to be capital structures out there, both in real estate and in companies, where there's going to be some kind of restructuring. But that doesn't mean that the world's going to fall apart. But we do have to get back to rational interest rate levels and rational capital allocation, which we haven't had.
Along with your being a little bit more friendly towards the markets, you like small caps. Not everyone does.
Yep.
Right?
I do like small caps.
Most people are sort of running from
They are
Russell.
running from small caps. I do like them. I think we've had an unusually high increase in interest rates. That has had a negative effect on the smaller companies in the United States and, frankly, around the world, in Europe as well. And when those interest rates moderate, small caps are going to fly, and they're significantly undervalued. And people should look at their portfolios and make sure they've got some allocation to it, because they're very under allocated.
You're moving your business somewhat more towards the big institutions and private investing. What's behind that?
We have evolved a bit.
Willie Sutton, that's where the money is.
Yep.
Yeah. Well, no, that was never at a question. No, I thought for a while that it was possible to actually reach the retail markets with this very low base fee and charge for performance, but it was challenging. The distributors found it challenging, and so, frankly, we just decided that we built it for institutions to begin with. We were trying to give the broader marketplace an opportunity to buy those kinds of products, but institutions still have significant interest. But you had to have a track record of 3 years or longer to sell to institutions, and now we do.
Get Andrew as a client now if you're going for the bigger.
Yeah, well, Andrew's right on my list. He's right on top.
He's now probably selling index Bitcoin indexes as well. So
we're not doing that.
Not touching it.
No, we're not touching Bitcoin.
When your customers say, or your clients say, hey, should we have any exposure to this stuff, what do you tell them? And you don't look at me when you answer this question. Look at him.
Yeah. Well, on Bitcoin specifically, I look at Bitcoin a little like gold. I don't really understand it. I don't understand where the value is. There's a scarcity question. People invest in it because they think the scarcity will continue and it will grow. I just am unconvinced by that. If I don't really understand it, I just don't invest.
But you believe gold scarcity will continue?
No, I don't actually invest in that either.
But you understand why it had value for 5,000 years, or no?
Yeah, I agree. But you can't determine the manner in which that value goes up or down.
From stock to flow, there's a way you can do it depending on how much gold is produced every year and how much is...
I think that there's not a lot of correlation between the supply of gold coming out of the ground and what happens to the price.
An ounce of gold is worth what a good suit would cost. And it also has a relationship to oil. So it'd be worth about a third of what your suit would cost.
But when I got married, what I paid for gold on a per ounce basis was as much as I could buy a car for.
Right.
That's not the case today.
Now it's what you're.
It's a lot cheaper.
It's what
today.
those fancy glasses cost. I think
the fancy glasses
an ounce of gold.
And the gold are about the same. But before, I mean, I could buy a whole car.
Okay, Peter. Thank you.